Principles of Accounting 2, Chapter 22. In Chapter 22, we talk about responsibility counting. So, responsibility centers are units within an organization that are different departments broken down into smaller units that have different functions. So, then we look at accounting for these smaller units. So we have many names for these responsibility centers. We can call them units, divisions, departments, branches, sales territories. We're going to use the term responsibility center throughout this chapter. Each responsibility center generally has a designated manager who is responsible for directing the activities of each center, which is why we call it a responsibility center. So when we want to look at information about responsibility center performance, why we would want to measure that? Well, we need to know how well various departments and units are performing in order to set goals, in order to determine how many resources they need, to decide if different areas need more staffing, if we also might decide that some areas are underperforming and what things we can do to help them improve their performance. So we also have controlling operations. We want to make sure that everybody's operating at expectation. If they're not at expectation, we are going to look at them for a discontinue or a closure. We also look at responsibility center performance to evaluate managers and to determine how well managers are doing, and if we do bonuses, if that manager is eligible for a bonus based on their performance. So we're going to look at this company, this electronics company. They have a mail order facility and several retail stores, and each store has its own sales area and repair facilities. So we have this org chart for this company. We have the board of directors, the top management, and then we have the retail division and the mail order division. We have two locations for retail division. Those are profit centers. Then we also have cost centers, which are accounting and janitorial, and investment centers. And we're going to talk about what each of those different types of centers are. Cost centers are business sections that incur costs but don't generate revenue. So every business has cost centers. Usually they're IT services, accounting, human resources, legal services, maintenance, janitorial. They provide services, but they don't sell goods or services or bring in outside revenues in any way, but they're beneficial to the company internally. So cost centers are evaluated on both their ability to control costs and the quantity and quality of services that they provide within the organization. Cost centers don't directly generate revenue. We don't prepare income statements for them. However, we must look at their costs incurred and evaluate them based on their costs. A profit center is just what it sounds like. They generate profit. They have both revenues and costs. So retail stores, sales, repairs departments are all profit centers. Sales departments within an outlet. So we could have a retail store and then evaluate each department separately. We can have sales territories. We can have individual product lines that we look at also. Profit centers need to generate profit. They're evaluated primarily on their profitability. The managers of profit center are responsible for using that store's resources to generate revenue. They do not have authority over or responsibility for anything outside of their profit center. And an investment center is a profit center for which management has been given decision-making responsibility and an ability to make capital investments. So they have the ability to buy buildings or to expand. So to evaluate the performance of an investment center, we have to look at the cost of assets used in the center's operations. So we have a responsibility accounting system, and this system is designed to measure the performance of each individual responsibility center. This helps provide the top management and board of directors with information that can identify any strengths and weaknesses among our different units, different regional areas, different departments. So we use what are called responsibility income statements to show our operating results. This is an example of a responsibility income statement. One, we use a contribution margin income statement. So instead of sales minus cost of goods sold equals gross profit, we have sales minus variable cost equal contribution margin. We then have the fixed costs that each department is responsible, and then any common fixed costs that are part of the company's fixed costs. So we can see that we have the division's responsibility margin and then the entire company's net income as a whole. And then we've broken down that retail division further into our two separate locations, the 42nd Street store and the Baker Street store. When we're assigning cost to parts of a business, we look at two concepts. First, we look at cost behavior. So what is variable and what are fixed? We use a contribution margin income statement so that we can see directly the behavior of costs. Then we look at the costs that are directly traceable to that center. So it's costs that only happen at that center. Thus, any traceable cost should disappear if the center is discontinued. Variable costs are those that change in proportion to changes in volume. So variable costs are related to specific revenue dollars. They're traced directly to the profit center responsible for generating that revenue. So we go back and add on to all of these chapters that we've been looking at with the CVP analysis and the short-term business and stuff, where we're looking mostly at the behavior of costs as where they are variable or fixed. Our contribution margin is the relationship between revenue and variable costs, and it's the amount that we have left over to contribute to covering fixed costs. This is contribution margin as a short-run planning tool, useful in decisions and information about changes in volume that will not significantly affect fixed costs. So remember, we're always operating within that relevant range where costs are linear and fixed costs stay the same. Fixed costs, we know we're going to look at traceable fixed costs. So those fixed costs that only exist because the center exists and could be eliminated if the related center were closed. And then we have common fixed costs. Common fixed costs jointly benefit multiple parts of the business. So this is where we get into the accounting department and the human resources department and the janitorial department, IT department. So when we're looking at these fixed costs, we have the fixed costs traceable to stores, as we can see here, and the common fixed cost. Then we have a responsibility margin. So in addition to the contribution margin ratio, we can also have division responsibility margin ratio. And we can see here that we have the retail division and the mail order division. the retail division has a higher responsibility margin than the mail order division. So for a responsibility income statement, we can look at these two profit centers at the 42nd Street store. And we've broken that down then into its sales department and its repairs department. And we can see here that the repairs department is not generating any revenue or has negative departmental responsibility margin. Some fixed costs that are traceable to a center are beyond the manager's immediate control. We believe that most costs within a center are under the manager's control, but some of those are beyond the control. So some of that can be high costs because of where they're located. And if they have high costs that are beyond their control, then it can negatively impact the manager's performance, which can upset the manager if it affects their bonus. So we want to subdivide those traceable fixed costs into controllable fixed costs that are under the manager's immediate control and committed fixed costs that the manager cannot readily change. These would be depreciation and property taxes and any rents that are based on the area that they're controlled. So in our responsibility income statement, controllable fixed costs are deducted from contribution margin to get our performance margin, and committed fixed costs are then deducted to determine the responsibility margin.